Hi, I'm Jennifer Siegel from Derivative Logic, and welcome to another edition of What I Learned This Month with our in-house economist, John Rothfield. As many of you already know, John has a long career as an economist and financial market strategist for Bank of America. And then he subsequently worked for CalPERS as their chief economist and portfolio manager. And CalPERS, as I'm sure many of you know, is the public pension for the state of California. This month, we are going to have a little bit of a different format in the What I Learned This Month, where we engage in a little bit more of a Q&A style discussion about the economy, the Fed, and interest rates. And John will still be producing a chart package that will be circulated when we send out the replay to this discussion. So, John, I wanted to start by asking you about the April payrolls report, which was released this past Friday. The jobs number came in much above market expectations, but we didn't see so much of a move with equities, bonds, the dollar really didn't seem to do much. Why do you think we didn't see more of a reaction?
Well, that's an interesting question. I've been following the monthly payrolls number for more decades than I can care to admit on this webinar today. But one interesting thing about the jobs report is that it is the report that moves the bond market more than any other report. But often by the end of that Friday, those changes have reversed. So you get an initial reaction to payrolls, and then the markets end up at the day roughly unchanged pretty much. So I think that partly reflects the fact that the nebulous concept of what is maximum employment. There are so many measures of the labor market that come out every month. The Kansas City Fed, for example, has something called a labor market conditions index, which looks at 24 different indicators of the labor market. So yes, we did get a jobs number of 115,000 for the month. That was double expectations. But that had been flagged anyway by the ADP report that was also strong the day before. And there is emerging in the labor market a very interesting contrast between the payroll survey and the household survey. So the household survey, which is interviews on households, has showed a much weaker trend in the last 6 months, including around the government shutdown. So the labor force has been declining, employment has been declining. And part of that is that some people have been taking out multiple jobs, and they show up as two payrolls, but they only show up as one on the household survey. So if you actually look at the unemployment rate, even though the headline didn't change, there was a 0.08 increase in the unemployment rate when you round it to 2 decimal points. And another number that people look at is U6, not U3 unemployment, but U6, which is a broader measure of underutilized labor. That continues to rise. So people who would like more hours, things like that, those guys are finding it more difficult to get jobs. If you look at that Kansas City Fed Labor Market Conditions Index, which is those 24 indicators, it actually fell in the month of April overall. So it's basically saying that there was a slight weakening of the labor market. But when you look at this indicator and all the others, it's pretty much showing that the labor market is still in balance. So the Kansas City Fed indicator is close to zero. So is the New York Fed measure of labor tightness. I want to mention one other thing that I think is really important recently, because in the state of Florida, the unemployment rate, Rick Scott, the senator down there, has been talking about the rise in unemployment in the state of Florida. So I looked at something which is called the SAM index for going at state level. Is the unemployment rate rising at a critical rate in certain states, or how many states is that happening? And right now we're at a point where there are 15 states representing about a third of the national labor market where the unemployment rate is rising fairly quickly. That includes Florida, but also states in the Northeast like Delaware, Connecticut, Maryland and Virginia, which you might expect because of the government slowdown, government hiring slowdown, but also states in the Midwest and out west as well. So if I was looking at the labour market as a whole, I would say that the labour market is probably not operating at what the Fed regards as maximum employment, despite a couple of recently good numbers in private payrolls. You're also worried about where the private payrolls are coming. Some of them are coming in the healthcare sector continually, which is not kind of relevant to the business cycle. So again, when I look at the reaction to that 115,000 on payrolls, I would say in the totality, the labour market is flat to slightly weak overall.
Interesting. It sounds like it's a little bit more of a mixed bag or data on each side of, of the aisle, I guess, so to speak, when you actually look into the data more deeply and into look at the other indicators.
Exactly. Yeah.
Yeah.
And
Sorry.
economists love that. They love being two-handed anyway. So
Well, yeah, it's you can't be wrong. So the next topic I want to hit on is inflation, which has certainly got a lot of press recently. There's sort of an anecdotal sense that inflation pressures are accelerating, perhaps in service prices, maybe because of the tariffs, housing, etc. Is that perception actually showing up in the data, or is this more of, consumers and businesses focusing on kind of these headline numbers and certain very visible price increases?
yeah, you're right about perceptions. There's two measures of consumer confidence. One is by the Conference Board, which is mainly looking at labour market. That's on about its long-term average, which is kind of consistent with this idea that the labour market is about neutral right now. But the one that looks at things like affordability, the University of Michigan Sentiment Index, is pretty much close to all-time lows. And time to buy a durable good or time to buy a vehicle, time to even buy a house, etc., are extremely low right now. So the perception out there is that we are in a market where things are getting and staying very expensive. And yes, I would say that this CPI inflation number that we had yesterday was a little bit of a game changer. And even, the new, we'll talk about the new Fed chair, Warsh, in a little while. But I think this has been a game changer. So I looked at the 4-month annualized rate of change in inflation for a few of these indicators. The headline in the last 4 months at an annual basis, and this is seasonally adjusted, has risen by 6% for the CPI. Food 3.3, energy 49%, shelter 4%. The super core, which takes out food, energy, shelter, and some other goods, super core this year has risen by 4.8% annualized. The median CPI 2.9, trimmed mean, which Kevin Warsh wants to look at, that's risen at a 3.2% rate. And so-called sticky inflation, things that change price relatively slowly, that's risen at 3.5%. All of these are over 3%. And, the breadth of rises in prices is really focusing people on, whether this is just a one-time temporary shock because of the war with Iran causing energy prices. That can eventually seep into other prices if energy prices don't come down. But aside from that, so you have the big movers in the CPI, gas, gasoline, airfares, intra-city travel. So Uber and those guys are increasing their rates to pass on higher petrol prices, utilities, but also computers. Because of the AI boom, prices of computers, you're seeing that in the producer price index as well, are going up. So computing, streaming, music streaming, video streaming, apparel, toys, floor coverings, and dishes. Some of the things that were tariff impacted, and that tariff impact was supposed to have gone away by now, because we're about a year out from the Liberation Day tariffs. Those are still affecting the CPI. So I would say that again, the CPI report yesterday is a wake-up call for the fact that we're not yet at the point where we may have an episode like 21, 22, where inflation got out of control of the Fed and the Fed was slow to act to it. But there are stuff going on. And I will mention two more things. One was what they call the Global Supply Chain Pressure Index that the New York Fed puts out, which measures things like shipping rates. That spiked in April, and so did the Producer Price Index for things that were non-energy as well. So yeah, I think the perception out there is a lot of inflation in the economy, and people are losing ground with their incomes relative to prices, and I think it's being shown out in the data as well.
And, if we do continue to have some of this sticky inflation, where things aren't really able to move out of these prices, like some of the things you mentioned, still having price increases from the tariffs, a year off, is stagflation perhaps a risk, if we also aren't seeing growth, move up as fast?
Well, we are already in a stagflation episode. You look at the average growth of the economy in the fourth quarter and the first quarter, it only averaged about 1.7%. So you had a half and then a two. One was affected by the government shutdown, but we were supposed to snap back after that. So we're operating in an economy that's growing at a little under 2% right now. The median forecast for this current quarter we're in right now is 1.5% as well. So let's say we're operating in an economy that's growing like 1.5 to 2% annualized per quarter, but inflation is much higher than that. So what they call the GDP deflator has been growing at a rate in the high threes. The estimate for the deflator in the second quarter, which we're in right now, is getting up towards 6%, 6% annualized. So if you're looking at an economy that's growing at one and change, and you have inflation in the kind of the 4 to 5 to 6% range, you definitely are having a period of stagflation. Whether it's temporary or not, we don't know. But I think that's a good way to characterize where we are right now.
Okay. And kind of building on that, it makes you think a little bit about recessions. And, I feel like economists, the market in general, have spent probably the last 2 years saying, no, there's not really necessarily a recession happening, or at least pushing back the expectations. But, when we see these lower growth numbers, or even policy uncertainty, that kind of comes back up. And so what do you think, or how should investors think about the possibility of a recession?
Yeah, that's a good question. That's always a question. And we had a model at CalPERS which looked at, what is the probability of recession in the next 12 months based upon a set of economic indicators, because that essentially helped to guide the decision about where you should be in bonds versus equities as an overweight or an underweight. So that's obviously an important question to everybody. The thing about recessions is that ever since we've had just-in-time inventory and things like that, most of the recessions we've had since then have been financial recessions, and they only tend to happen about once every 10 years. So early 80s, early 90s, early 2000s, early 2010s. There was a COVID recession in the early 2020s. We can't blame economic policy for COVID, but the economy was starting to falter anyway toward that part of Trump's first term. So we get a recession about once every 10 years, and it tends to be based on financial indicators right now. However, the most economists now are looking at a 20 to 25% chance of a recession within the next 12 months. That's not really giving you much information because, believe it or not, we're in the 7th year now of a post-COVID expansion. So basically, if you think about seven years being, 7/10 of the way to a likely recession, that 20 to 25% is about right, and it's not really giving you much information. The information that I would say is I don't believe that we're going to have a recession in the next 12 months. And part of that is because the typical indicators the National Bureau of Economic Research looks, and they do the business cycle dating committee, those guys have various indicators that tend to turn over before we get into recession. And they aren't really turning over right now. So one of them, for example, is real manufacturing and trade industry sales. So manufacturing shipments. You've actually had an improvement recently in some of the indicators in the manufacturing sector, manufacturing orders, core capital goods orders, retail trade, wholesale trade. Those things are still rising, and you typically have to have a period where they've turned over to start flashing more succinctly for a future recession. And then, of course, we have things like profits, which are extremely high, record profits. And it's not only in tech, it's across the board, which provides a cushion. The other cushion is the consumer balance sheet, which is very strong. We haven't had an over leverage experience in the economy, except in a couple of parts of the economy. Now, we do have this dichotomy between the rich and the poor, high, middle, and low income earners. There is that dichotomy going on. Is there enough concern about the low income end of the spectrum breaking? There has to be some, but overall, I would say we're very likely to continue in economic expansion mode, for example, for the next 12 months.
That's interesting. Thank you. Yeah. I think switching gears a little bit, you've often talked about, in previous sessions here, the impact of the deficit and debts on the bond market. And why don't you think we've seen a significant melt up in borrowing rates to reflect this so-called twin deficit?
Yeah, there's a measure of what they call the term premium, which is the amount that's built into the 10-year bond that isn't explained by the market expectations for the future Fed. It includes things like volatility of inflation, various other things like that. So since the month before the last election, the term premium has risen by 50 basis points, which seems to be a fairly fair indicator because we have had this radical economic policy that has produced higher budget deficits. The trade deficit remains very high, etc. So I think that number one, all of the information for the future is already out there. The Congressional Budget Office says that the deficits in the future can continue to be very large. The trade deficit we know about and the persistence of the trade deficit. And so it's going to be hard to find some news that's actually going to cause that term premium to rise even further, particularly since the trade deficit has actually slightly improved recently. The trade deficit is still about $900 billion a year, the US trade deficit. But the deficit in things like pharmaceuticals and various consumer items has actually declined. The main reason that we've seen a persistence of the high trade deficit is this AI boom we have in the US. There's been a massive imports of computing, computers, peripherals, semiconductors, things like that, which has tended to keep the trade deficit wide. So I would be fairly optimistic that at least even, things like tariffs and various other policy things like in pharmaceuticals have managed to stabilize some of the worst elements of the trade deficit. And if you've got a trade deficit that's built on capital spending boom, it's not as worrisome as one that's built on, Trump's idea of, poor people have too many toys, that kind of thing. So we have had an improvement in the underlying trade balance. Also, the budget deficit this fiscal year is running at about 1.7 trillion rolling versus what the Congressional Budget Office thought would be 1.85. So we have had a fairly minor improvement in the budget deficit compared to what had been expected in February. And another important factor is that Scott Bessent, the Treasury Secretary, has been funding the increment to the deficit in Treasury bills. So the weighted average maturity of the portfolio has been changing, And so we can't have that forever, but the Treasury has some ways to manipulate the way it's funding its deficit to keep a lid on that. So, you know, we continue to think of this as a boiling frog at some point, particularly if we had a recession and the budget deficit really blows out. You could really get a melt up in long rates because of that terrible funding need that we have. And the administration continues to do nothing about long run budget outlook. But at the moment, I think that issue is already priced into the market at the 50 basis points that we've had since last year.
Interesting. And I guess speaking of rates and how, the politicians or the the Fed or other folks that work there, what they can do about it. The Fed is obviously responsible for short-term rates, but they are going to be undergoing a meaningful leadership transition just any day now, arriving at a time when we talked about inflation's a bit sticky. You have some slowing growth. There's also all these political pressures on monetary policy. What do you make of that? What types of changes do you think we will see at the Fed?
Well, I'll definitely be getting some popcorn for that first FOMC meeting and watching how it unfolds and the press conference and President Trump's reaction to it. It's going to be really interesting because, yeah, Kevin Warsh is coming in at a very interesting time. I think the most important thing about his first meeting is he probably faces a hostile committee. Uh, it looks as though if Jerome Powell is staying around, that Steve Myron will be gone from the board. His appointment was only temporary, so he'll go back to the Council of Economic Advisors. So what you're left there with is Kevin Warsh, Chris Waller, who was also in line for the job and is also kind of a cautious dove on rates. You've got Mickey Bowman, who's very dovish. She's almost like a Steve Myron. She was a hire under the Trump administration. So you've got those three that may be arguably for rate cuts, but you've got a board otherwise that has been more neutral. Four of them were appointed during the Biden administration. And then you've got four voters this year who, three of them were hawkish dissenters last time. They didn't want the statement to have the presumption of additional easing at some point in the future. That was Beth Hammack from Cleveland, Kashkari from Minnesota, and Lori Logan from Dallas. So you're looking at a situation here where really, perhaps with Ann Paulson at the Philly Fed, who's another one, basically saying that ultimately we want to get down to low threes in rates, but we may not be able to now. I don't think there's going to be any kind of appetite to cut rates at all in the first few meetings leading into the midterm. So that is going to be very difficult for Warsh to be able to present that. Warsh was very critical of a couple of things. One of the things he was critical of was the 2021-2022 episode, where the Fed kept rates too low, too long, and then inflation got out of control. That may not be completely fair, but it's out there. So he can hardly go now and start cutting rates in a very similar situation. And then finally, there were Janet Yellen and somebody else published an op-ed in the New York Times a couple of days ago, going to this issue about Kevin Warsh's view that we're in a supply side revolution in the US, which is keeping costs contained and provides the basis for a lower Fed funds rate. Janet Yellen and others on that side of politics, because let's face it, the Fed has become politicized, have said the supply side economics hasn't worked in the past, and that AI is also raising demand as well as supply. So these are very difficult issues for the Fed to manage. But I would say that we're going to see a different Warsh early on in his term, speaking about the need to get inflation under control. And yes, there are some issues with the labor market, but generally it's considered to be broadly neutral. It could do with a cut to stimulate in some of those states where the unemployment rate is rising, but inflation is the biggest issue right now.
So do you think the Fed's dual mandate will stay kind of roughly the way it has been in terms of focusing on inflation and employment, or do you think it's going to tip one way or the other?
Well, I think the dual mandate will stay, but how they prosecute that dual mandate may change. The Kevin Walsh has been looking at something called the trim mean PCE deflator, which just coincidentally has actually been one of the lowest in the last 25 years. It's only averaged about 2.25%, which isn't too far above the Fed's target. Most of the other measures of underlying inflation have been higher than that. So there may be some changes there, and I would expect the Fed to be doing less talking. I don't even know whether they're going to continue with things that Ben Bernanke introduced, like the dot plot, the summary of economic projections, stuff like that. I think that will change. It will eventually, but it will change over time, as will Fed policy toward balance sheet. Kevin Walsh has said that along with the Treasury Secretary, they would like to, in a stealthily manner, reduce the Fed's balance sheet. So there are a lot of things that are going to unfold in the Fed in the next couple of years, particularly in this first term while Trump is still president, that could reform the Fed and elements of transparency and stuff like that. But for right now, they're dealing with the short-term issue of the risk of more generalized inflation coming from the war in Iran and how the Fed could respond. And I wouldn't totally rule out the possibility that ultimately, if this continues down this path, we could even get a tightening.
Interesting. You know, I think you talk to people, and especially with Warsh coming in, some are still hoping that we see some sort of easing cycle. Not that the fundamentals, support that per se, especially at this point. But in terms of looking further out the curve, where do you see kind of interest rates, the Treasury yield curve heading over the next year or so?
Yeah, well, just finishing up on the short end first, just on the day before the war, 27 February, the market was still pricing in one or two Fed cuts because we had come out of this period of low economic growth following the government shutdown and this expectation that tariffs would roll out of inflation. Then we moved to a situation recently where the market was pricing in a flat treasury, a flat Fed funds curve going forward. And now we're almost at the point where we have a full hike priced in for the Fed in the next 12 months. So that's been a big repricing, and that last repricing was due to inflation. And I think it is a reasonable market reaction to that. So what do I think the Fed is most likely to do? Well, like anybody on the Fed board of the Federal Open Market Committee, again, it's this issue. It's a cop out to say it depends on what's going to happen, because there are left and there are right tail risks. But overall, I would say it's likely that we're going to be in this high rate environment for a significant period of time, because the chances that we move back to low inflation in the second half of this year, I don't think are really there. And I do think there are some green shoots in the economy that are being picked up in things like beige book surveys, etc., that suggest that if we do get a lasting truce in the war with Iran, that the economy can have a second wind in the second half of the year. So it's hard to say that the Fed will be hiking in the next 12 months, but I do think we have to get used to this high interest rate environment that we're in right now. As far as the long end of the market goes, in the best we could manage when inflation was rising in 2021, 2022, is we got to 5% on the 10-year bond. This time around, we haven't had the same inflation shock yet, but we've got to 4.5% on the 10-year bond. And again, I talked about this before with the term premium. We already have some juice built into the term premium that I don't think there's going to get any worse. I still think that the direction of travel in the rates in this cycle is still back toward 5%, with a 4% 2-year. And so, yeah, the direction of travel, in my view, is still that we get higher rates. Now, if we were start to getting a faltering in the economy and then the budget deficit starts to increase again significantly, then you could get a steepening of the curve. The curve steepened out to 75. It's now at about 50, but we could steepen out again to about 75. So the message I think I would like to leave from all of this, a neutral jobs market with some problems in certain states, but also very high inflation, and a new Fed chair who in the past has been critical of the Fed, that hasn't been vigilant to high inflation, is we're in a high rate environment where rates could even drift a bit higher.
Thank you, John. That was a good sort of summing up. I think we're right around the 30-minute mark now, so I think we'll try to wrap things up. If anyone has any questions, feel free to send us an email to the address us@derivativelogic.com, so us@derivativelogic.com, and we'll do our best to get John's expertise and answer it. And while you're over there, go to derivativelogic.com for more resources such as our weekly Straight to Smart newsletter, which you can sign up to receive in your inbox, forward curves, and other interesting resources. So thank you to everyone for joining, and thank you very much, John, for all of your expertise.
Been a pleasure to talk to you today, Jennifer.